Daily stock market update on the 28th of November, just before US market open at the time of recording. The big story is that the US markets, well, the Chicago Mercantile Exchange had an outage, and that disrupted trading across global markets. Apparently it's been fixed. We don't think it's a cyber attack. Looks like there was some overheating, which could be a cyber attack. What does it mean? Well, regardless of that, the market's likely to extend the rally, I guess, post-Thanksgiving. Good feeling and good sentiment for people. Oil is set to drop fourth month. Glut of output. That's good for stocks. The fact that the S&P is to rally is good for stocks. Certainly sentiment and negativity didn't last long by the looks of things for now. Those are the big stories on the news wires. I will speak to you about the broader economy now. FTSE 100, after the budget, it's not rallied. It was fairly flat. And it could be because, well, there's a lack of positivity around the budget. But I think the thought was at least it's not as bad as it could have been. And in any event, if the macroeconomic outlook in the UK gets worse, then the Bank of England can step in and cut rates. So domestic sentiment, nothing changed. I don't think if you did a poll, you would see consumer sentiment increase. Remember, there's three components to the economy: government, consumer, and investment. Investment being business investment. So has consumer sentiment suddenly spiked up? No. Government spending increasing? No. Business investment suddenly likely to spike up? No particular reason it's changed as a result of the budget. So putting aside any biases you might have, that if you listen to politicians, it was the greatest budget ever by the greatest chancellor ever in history, or if you're on the other side, worst budget ever by the worst chancellor ever. Putting aside any of the biases, at least it keeps things fairly flat. Now, the UK markets are up some 22% so far this year. That is very unusual for the UK, and it isn't due to economic growth. If anything, it's a catch-up on undervaluation. Can it continue? It's benefiting from the fact that there's clearly some money which wants to get out of the US and be more diversified. And it's not necessarily going to China. Some of it's going into Europe. Some of it's coming into the UK. There'll be a limit to that story because the US is also at all-time highs, which instead of drawing in all the money from around the world is actually spreading the wealth somewhat. Obviously, Americans themselves tend to invest domestically, but some of the international funds are looking to spread. What does that mean for us? Well, it's not changing my outlook on individual companies. They still have to be the best, and if they happen to be American, so be it. Should the Brits... Remember, you've only got 100 companies in the FTSE 100. For the US markets, I've got about 8,000 to choose from. You could say, well, why are you only looking at FTSE 100? Well, once you get below the 350 largest UK companies, you've got a liquidity problem, and therefore you've got a volatility problem. Liquidity meaning how much volume there is and interest in buying and selling those stocks. I don't like to take risks with my pension, so I don't like higher volatility. So will the ISA changes make a difference? No, it certainly made the brokers like Hargreaves Lansdown and the wealth managers like St. James's Place pull the wool over the eyes of the Chancellor and say, look, you've got to get more money into UK markets. Sadly, what's fundamentally true is I don't think she understood how the stock market works. When you reduce cash in an ISA and say to people, invest in stocks, of course, they don't necessarily do it. But if they do invest in UK stocks, that money's not going to the company whose shares they're buying any more than if I buy a second-hand Gucci scarf from the homeless person at the end of the street who was gifted it by some tourist. That money is not going to Gucci. It's going to the homeless guy I bought it off. Got it? And that's why it's called a secondary market. A primary market would be the initial public offerings, but that would require British investors, pensioners, savers who were previously very risk averse, so risk averse they put their money in ISAs, to then invest as angel investors in a pre-IPO company in anticipation and expectation that that will IPO. And there's another problem. Stocks and shares ISA rules would limit the ability to do that. So who's benefited? Stockbrokers who will sell you funds which invest, well, they don't invest in UK companies. That's just simply wrong. They buy the shares of UK companies. The money goes to the person selling it to them, which invariably might be an American firm. It could be another fund elsewhere. So fund managers are selling and buying stocks from each other, creating commissions and fees. None of that benefits the underlying company. You might say, well, surely if there's a big demand, the price of the stock goes up. Again, doesn't benefit the company or entrepreneurship in Britain or make you want to buy another stock directly. It means the shareholder who sold it at a higher price benefits. Well, surely that's the pensioner. But you can do that anyway if you own Nvidia. And if it goes up as a British pension owner, I can get the benefits from owning that company. So surely what we should have taught people is to buy the best companies, cut out the middleman. Anyway, it's a subtlety which sadly is lost on Her Majesty, on His Majesty's Treasury. Now, going forward in terms of other global equities, European equities have been doing well recently, actually this year as a whole. And they're often overlooked. Most people, sadly, their brokers won't give them access to European stocks. And you might say, oh, I can't even get the data. And that's fine. There's enough American data and American stocks. Partly because of regulation, partly because the EU loves to make life harder, and partly because there's just so much cost involved of doing it. So sorry, Europe, you're still not getting into most people's portfolios. On Wall Street, the story's gone back to interest rates and big tech. Okay. And it really is being driven in the short term by sentiment. In fact, if you look at short-term price movements and a random distribution, what you might even call Brownian motion, and experiments have been done on this, it does look random in the short term. Okay, so minute to minute, hour to hour, day to day, it's only when over a longer period of time, the fundamentals of the company get applied to prices that it starts getting some kind of a direction. In other words, stock prices move a little bit like what my maths teacher would call an inebriated arachnid, a drunk spider. It'll eventually get to its destination. It's just that the direction it takes is pretty unpredictable, but it eventually gets to what the fundamentals would suggest. Okay, so we're still looking for interest rates, no big changes in expectations, and interest rates to drop in December. So that keeps the market rallying, keeps everybody in a good festive mood as well. So what should we watch next? Well, keep an eye on any signals from the Bank of England on the timing of rate cuts and on whether inflation is, I mean, it's at 3.6% still. It's above the benchmark target. Okay, so interest rates ought to come down, but the argument is if interest rates come down, surely that fuels more inflation. Therefore, we should keep interest rates where they are. But of course, keeping interest rates higher increases costs. And by increasing input costs, it also keeps inflation higher. So it's a lose-lose on interest rate direction, which is why it's not clear which direction the Bank of England will move interest rates in. They certainly won't raise them for the moment. Okay. Also, keeping an eye out for any US jobs data. That just helps. Bit of noise fills the journalists on TV and their written articles. Nothing to really worry about there. I guess the big issue at the moment is no news is good news. There is no relatively negative news, and therefore, in making those three decisions of buy, hold, or sell, if you already own, you're just holding. Would you sell? There's no reason to panic. Would you buy more? Well, given that we're overbought, as the technical analysts might say, or some of the valuations are expensive, but not in the tech companies, then you might just edge in slowly if you are risk loving or not so risk neutral. If you're risk neutral, you'd probably edge in even slower. If you're risk averse, well, you're risk averse. You'd put your money in a bank account. It's that simple. As ever, a quick request for you. I do these. If you want me to continue doing these, the way these algorithms work is if you repost, if you comment, if you like, comment on YouTube is the most important. On TikTok, saving the video is the most important in terms of how these weighted algorithms work. That way, it goes to more people. If it goes to more people, then I get more views. If I get more views, I continue doing them. If I get more than 3,000 views per day on these, I continue doing them. My most popular videos on TikTok, by the way, reach 7 million views. So I hope you will save it if you're on TikTok, and comment. Please do let me know if you're enjoying these and liking these. And for those of you on YouTube, please do like and comment. The comment engagement on YouTube, I believe, works even better than just simply liking. And don't forget to subscribe and follow. That does rank things. So these algorithms, just as we have algorithms for picking stocks, weighing valuation, growth, dividend yields, and the like, and I've got a webinar today, and if you want to know where the webinar is, and if you ever want to see my live webinars, or a recording of them, the URL is always the same, alpeshpatel.com/latest shares. And if you can't remember that, the overall link you can find to everything that I do is on the screen in any event as well. So the way these algorithms work, as I say, whether you're deciding who to marry, where to go for dinner, what stocks to buy, is what's important, how important is it? With stocks, it's value, growth, income, Sortino, alpha, cash flow. That's what's important. The weights are equally important. You put more weight on valuation, almost equal weight on growth, some on momentum, and so on. Similarly, algorithms with TikTok and YouTube work on the basis of they will weigh, did the person save it? Did they watch to the end? Did they comment? Did they repost it? And they put different weights on these, and really the trick is to guess which the weights are, and they vary at different times. So like I said, I've spoken for a very long time about that. I hope that's educational and informative for you as well. And if you're doing videos yourself, it's a good idea to ask your audience, please save this video. Thank you all very much. And I'll do more stock market updates if we get over 3,000 views. Simple algorithm as well. Thank you.